Going twice, sold. You're listening to the Property Pod.
All right, guys, welcome back to the Property Pod, your easy to listen to and accessible way into the property market. I can see Patrick Berry opposite me on the desk with his Property Pod t-shirt on.
I'm rocking a Property Pod t-shirt today.
You just wanted to rep the brand a little bit today, just make sure that everybody knew we were recording.
Yeah, pretty much.
Yeah, fair enough. And
I
John,
actually didn't want to wear a suit. Not that I ever wear one anyway, but I just felt like a t-shirt today.
John's not wearing a fur coat, but it's that damn nice tartan one that he's got. It's a really sharp coat, my man.
I do like the burgundy. First time I ever bought burgundy this in 2020, never looking back.
I did wonder, the colour scheme here at 414 is kind of that darkish red colour.
Yeah.
I'd never seen you wore it until you became a member here. Was it kind of a uniform change? Like you're like, all right, I'm getting rid of the old colours. Now I'm wearing something new.
I think it was just, what would you say, good timing, serendipitous? Is that a word for it to make it sound fancy?
Yeah.
It worked well for me. So now we're the black chinos and the red shirt, and it's like, might not have a 414 badge on, but the thing is all the colours match.
Yeah.
So I'm all for that.
Yeah, hell yeah. What's on the go today? What are we doing Property Pod-wise? Who are we talking to?
Well, it's actually Tuan from Duo Quantity Tax Surveyors. It's going to be what is a potentially dense subject, but realistically, if you're considering buying an investment property, you are an investor, this is actually a must listen to, because fundamentally, this whole podcast is going to be about maximising the tax benefits out of your investment property, which fundamentally, if you go into investment to build wealth, this is a huge part of it.
I'm petrified.
I'm pretty confident I'm not talking much for the next half hour.
I just have no idea what. I really hope this guy's knows his stuff, because I know nothing. I'm going to be just a fish in a barrel, just shooting at anything. And whew.
Here we go.
All right, so
So with that sort of intro,
Yeah.
good luck.
Well,
Listen along, and you'll see if you'll hear us make any sense as this goes on. But we really thank you for getting the guest in, John. We're looking forward to this chat.
Yeah, no, I reckon. I reckon we'll be fine.
I'm pretty confident that you always find good guests, John, so it's going to be an interesting listen. Just Aaron and I might not have a lot to add to the conversation.
We'll go get a coffee while the chat's on. No, look, we don't. No disrespect to our guests. We know this is going to be.
Yeah,
a quality.
this is why we get good people.
Yeah.
So, yeah.
You got
And hopefully by the end of it, we'll all be more enlightened.
That's the point.
Let's do it.
All right. That's right, guys. We're here with today's guest. I have got Tuan from DuoTax Quantity Surveyors, someone that's reached out to the podcast, and we're happy to have them on. Good morning, Tuan.
Good morning, Aaron. Thanks for having us on. Great to join you guys this morning.
Not a problem, man. Can you just let the listeners know a little bit about yourself, where you're situated, and how you fit into the property game?
Sure. So myself, Aaron, I've been a property investor now for about 8 years, and part of that journey of being a property investor, I've come across tax depreciation. Part of anyone who's investing in property should be taking on depreciation, because effectively it's a legislation that's being provided by the ATO, the Australian Tax Office, to provide property investors the opportunity to reduce their taxable income or reduce their rental income, and by getting a quantity surveyor to assess the depreciation on a rental property. That means the building of the property is essentially depreciable, which allows the property investor then to assess for a lower rental income. That means they're paying less tax each year because their building is essentially depreciating. So then I had to get that depreciation schedule myself, which is referred to as a tax depreciation schedule, and that helps property and at that time helped me massively reduce my tax when I was on a 60K base. A long time ago, was a young fella.
Yep.
Which means that for me it went a long way. So then I decided, you know what, if it helps me in that with that much value, of course there's got to be other people out there who don't know about this service, like myself as a first-time investor. Huh?
Yeah, no, it's nuts. What was your background before you obviously bought your house and then learnt about it and went into it? Were you doing accounting and stuff?
Yeah.
Or?
I was I had nothing to do with it. I was a civil engineer. I used to sort of work with Lend-Lease and dig holes in the city and build high rises and that sort of thing. And I became a property investor, and I couldn't believe this guy turned up in my house. I'm not sure if you know the company Washington Brown. They came out to do a depreciation schedule on my house, and he was like, he whipped around for 15 minutes and he was gone, and he charged me like $700. I was like, get the hell out of here.
Yeah.
So I threw up the boots and I just started the business in 2015 and called DuoTax Quantity Surveyors. Now we've got maybe 15, 16 staff that work with us, and I've never sort of looked back. And we're trying to reach more people, especially first-time investors who deserve to know about this. It's not something that people just know about when they buy a property. So that's my job.
Yeah, it's amazing. It's kind of one of those things, as John said, we've got this guest coming in and, he's going to talk about tax depreciation. I said, oh, no.
Yeah, I'll be honest, John didn't sell it very good. Made it sound like the most boring thing ever. So
No, we can tell you've got some passion there, man, and I'm really intrigued to hear more about this. When you say kind of the depreciation of things, the little bit of research I did, it made it seem like, like the things that get used in your house or your rental property, your fixtures and your fittings and stuff like that, they're going to wear and tear over time, and then that's going to lower their value. Am I on the right track with this stuff?
Yep. Certainly. Yep.
So,
exactly right.
Yeah, as they're depreciating in their uses value, you're kind of balancing out the books across the board. I can see you nodding your head. That means I'm on the right track. But I feel like I'm about to fall off a cliff. Can you help me?
Aaron, I was gonna let you have a go there, but you did pretty well. Did exceptionally well. So you've got the gist of it.
Yep.
And obviously, there's a lot more legislation and tax rulings around it in what you can and can't claim, depending on the circumstances. Okay, so I'm more than happy to enlighten you on that.
Yeah, hit me with as much as you can, because
Hit me with your best shot.
that's as deep as I've got, and I'm out from here on in.
I think before, if we could get into the meat of it, we might be better off prefacing the kind of person that this is going to really benefit specifically. So I know a lot of the time in this podcast we've talked about, one, building a team, and then you've got obviously your home ownership if you're living in the property. But in this specific field is a bit more of a deep dive because it relates specifically to an investor if they've got an investment property. Is that correct?
That's correct. Typically, most of the time, this will relate to a property investor or even a homeowner who's thinking about switching their owner-occupied property into an investment, which is something I did myself when I first purchased my property. And the rules have changed since then as well as to how you can depreciate it. Because back then it was a free run. If you had an investment property, a owner-occupied property, which I lived in for the first 6 months and obtained a grant and things like that, then after 6 months, I decided to rent it out. I could depreciate the whole asset. Everything, including the building and then also the plant and equipment. So they're the two main keys of when it comes to depreciation. Nowadays, since 2017, they've actually changed the legislation. So you can't exactly just do that. You can't exactly just move out of it and rent it out and claim full depreciation like I used to be able to do back in 2012. So it's a very different market we're in now. And I think that was to do with easing. Mainly a lot of that we had this big housing bubble where everybody was buying property, and then the ATO came out with a legislation that was marked as part of the 2017 budget, which meant that because property investors were overclaiming depreciation on assets, that's where the ATO has come up with this legislation to reduce the amount of depreciation that's eligible for property investors, which I'm happy to go through in more detail.
Absolutely. So then, now we've got, I suppose, who this is going to be information's important to. So we'll carry on from where Aaron was starting the story. Would really just sort of finish the idea that we know that the depreciation elements is where the value decreases on your, the assets, etc. over time. So that's sort of as far as we got to. So could you then walk us through specifically what this, depreciation schedule really means in that, or what, so people can understand then?
Sure.
So that we can understand, actually.
Yes, that would be so.
Yeah, which is when I say people, I say me.
and that's the point of it, right? And like myself, John, many years ago, I had no idea about this. I bought my first property that became a rental property. Piece of cake to understand. Okay, well, we can claim council rates as a tax deduction, because it's easy. We've forked out the money. We've had to pay for council rates, so that's a deduction. Then you've got your water rates. That's another deduction. Then you've got your rental agency fees, which is your property management fees at 5% or 3%, whatever it is. Then you've got, maintenance fees. If there's anything that breaks, you claim a deduction on that because that's an expense on that, I guess it's not a business per se, but the ATO treats it like a business and allows property investors to reduce their taxable income with all these types of deductions, expenses. The other thing that we don't ever think about is depreciation, and that's why, because essentially depreciation is they call it a non-cash deduction. So it's only an on-paper loss, where a quantity surveyor, which is someone like myself, who's a construction economist, is approved by the ATO to assess for the value of the building and the plant and equipment within that building. Okay. Now, what that means is that we don't essentially have to pay when we buy this property for, say, $600,000. We don't essentially have to say, okay, I've physically paid for an oven, a range hood, a hot water system. We don't essentially pay for it, physically pay for it. So that means that we don't have to, we don't think about it when it comes to tax return time. Oh, these are my expenses. So this is where a quantity survey comes with a tax depreciation schedule, which literally is numbers, an on-paper loss that says, oh, my first year deduction is made up of plant and equipment and the building of $5,000. That $5,000 I never forked out, so I don't actually remember to claim it as a tax deduction, and that's why a lot of people miss it. So what to prepare a tax depreciation schedule, essentially I've got to go out, a quantity surveyor attends to the property, visits a property, surveys it for things like ovens, range hood, downlights, blinds, square meters of carpet, and then we work out a rate, a cost that we as a construction economist, we specialize in us understanding the cost of construction, and also work out the bricks and mortar, slab, the framework, the roofing, and work out, okay, how much is that building worth? Then we can compile, okay, this is the total value of the building. But the ATO says, okay, you've got an oven based on the tax ruling, which is 2019 at this stage, is a effective life schedule tax ruling, which says an oven will last 13 years, a range hood will last 10 years, and then you've got carpets lasting 12 years. They've got all these different effective lives which effectively allow the property investor to then claim depreciation at different rates. And then the rate for depreciation on the building is a fixed value, which is 40 years. So if it's 40-year depreciation on the building, that means because the building typically is expected to last a lot longer. And then what we do is then we line up two categories. So you got all your plant equipment, which is all your oven, range hood, cooktop, etc. They all bank into one column, which is plant and equipment, and the other would be your building, which is 2.5%. Now we take those two values in each financial year, and it's split over 40 years to give the property investor a very clear indication. This is how much I can claim in the first financial year, the second financial year, third financial year, all the way to year 40, and hence it's a forecast report to give the property investor an opportunity to claim depreciation as a tax deduction against their rental income.
So yeah, that's really interesting, because you've described before, we're so familiar with the instant claimable items. So those ones you expend immediately. So as you said, the rates, your management fees, etc. So obviously if your management fees were $1,000, you'd be claiming $1,000. But instant depreciation schedule described it's like, measured out over a course of time. And correct me if I'm wrong, Tuan, but just in this instance, say we'll go back to the stove example, which you said was 13, 14 years, correct? Or something like that. So then, okay, we bought the stove for $1,000. I'll try and do easy numbers, but then I'll just say over a 10-year lifespan, so it's easy for me. But then,
$100.
Yeah. So every year, so the stove was worth $1,000. So then the next year it had a deduction of value by $100, and so therefore effectively you've got another deduction of $100 that you can utilise as a result of the stove losing value. Is that sort of
correct?
A good number, correct?
That's correct. And then that's to put it in a very simple method.
Yeah.
There's actually, when we dive a little bit deeper, there's actually two methods of depreciation. They call it diminishing value and prime cost method, which I don't want to try to confuse anyone, but once we get into these,
confused, man.
Yeah.
But effectively, there's two methods of depreciation. They call it the prime cost method and the diminishing value method. Mm-hmm. The diminishing value method is a much more aggressive method of depreciation, whereas a prime cost method is a more linear type of depreciation method. And the ATO will allow you to choose one as a property investor, because the quantity surveyor is always putting both methods on every report. But once you choose a method, you have to stick to it. So that way you don't overlap on the claim of depreciation on the asset. Mm-hmm. Now, when we talk about building depreciation, that's called prime cost. We can't actually depreciate the building as a diminishing value. And prime cost is a fixed amount, which is a 2.5%. Same thing can be applied for the plant and equipment, okay, which is oven, like you said, $100 a year. But the ATO also has this method called diminishing value method for the plant and equipment. So things like the oven, yes, it's $1,000, but once the value of the asset falls below 1,000, they will allow you to aggressively depreciate the asset at 37.5%. And if it's valued less than $300, like for example, if I buy one, bar stool and it's valued $150, I can actually claim 100% deduction on that.
Right.
Because the ATO is like, well, that's quite reasonable. If someone buys an asset that's worth less than $300, why would you depreciate it over 10 years at $30? It's marginally not worth it. And that's my job, essentially, to work out, okay, what is the type of asset? Can we depreciate more aggressively? And if so, let's give them the deduction and encapsulate that in each financial year's deduction so we can make the most of the depreciation. And of course, as you guys know, if we can write off the asset in the earlier years and not have to wait 10 years, we're getting better value out of the property.
Absolutely. Well, that's the thing. You gain from, the whole purpose of an investment in Sunrise, it's a financial vehicle to building future wealth. And so the idea I'd see then of getting the maximum out of your tax returns is that's giving you better access to cash flow. So if you can, obviously organise your tax structure in this depreciation schedule as best as you can as an investor, you can have more money in your back pocket at the end of the year, which means you can reinvest that money back into the property, into other opportunities as well. And I suppose that's the purpose fundamentally of a quantity surveyor is, like you said, as a construction economist, it's to enable you to get as much tax benefits out of your property as you possibly can.
That's exactly right. And I think it's a really good, important point that you made there about, increasing and maximizing the return on investment of your property. And we talk about $5,000 or $4,500 per se as a deduction. And this is a real deduction. Typically, our average investor or clientele would claim somewhere between $4,000 to $6,000 on their tax deduction each in the very first year of obtaining the report. Usually, typically high in the first years. But if we talk about $4,500 on a typical Australian wage, you'd be getting back in your pocket about $1,500. Okay, I think $1,500. Let's just do a quick calculation there as a tax refund, right? After all net. After the calculation, if we say let's say 30%, we're claiming about $500 per. $1,500. Let's divide that by 52. We're getting $28 a week. So I think for obtaining a report that's worth maybe $500 to $600 that you're outlaying in your out of pocket expense, you're getting potentially $28 per week for the whole year. Okay, in the first year alone, and that's good cash flow.
Yeah,
and that's always good cash flow to always think about. Okay, should I re-inject this into my next property, or if you want, pay off your bills, whatever it might be. But it's a very good vehicle.
There's your guilt-free coffee budget too, if you want to look at it that way.
Or your Friday night Uber Eats if you don't want to cook.
Well, so this is a really interesting position then. So at the start, you said you bought your first investment property, but I think a lot of people go through this journey where they've had their primary place of residence, and then they think, well, I'm going to convert it into an investment property. And I think you said of it. So then some people might buy it outright. It might be a brand new property, it might be an old one. But a common scenario obviously is that we become an investor by accident.
You level up into your next house. You're like, that was my first home. I'm ready for my next one.
I've got some equity.
Oh, well, we'll just kind of rent this one out.
Yeah. Yeah. And so I know there was a thought I was thinking was before then, even when it comes to engaging a quantity surveyor, like it happens a lot of time, we always ask experts' advice after we've done the fact. So imagine then what is an ideal time frame if we expect we're going to be an investor in 12 months' time with primary place of residence. But we intending to do renovations. Is it then a point that we'd engage you, really, really early in the track, long before we'd even be considering either buying investment property or converting it into one?
Great question, John. When it's your owner-occupied property, there's definitely no necessary reason to get the depreciation schedule until we know for certain that we're going to rent the property out. Okay. When we do think about renting the property out, it's best to engage us before we have the tenants move in. Typically, that's when we get engaged the property manager says, okay, great, we've found a tenant for your owner occupied property. This is the date they're moving in. It'd be ideal to get the quantity survey in there in between that time, between when you're thinking about when you're moving out and when the tenant moves in. So that way it's vacant. The last thing you want is to have a new tenant and then they get all the disruptions and the disturbances. And this is typically why I recommend to get the report done then. A lot of people, I guess, after they've lived in it for 5 years, they decide to rent it out. They want to do a renovation. Best thing to do is have the quantity surveyor come in after the renovation so that we can assess the property for what it is and also what's been included. Obviously, typically you'd have maybe a builder's quotation or a builder's scope of work. We can work through the scope and find out, okay, well, if he's done this many square meters of carpet, redid the floor here, we can then work clearly to work out exactly the scope and capitalizing that into the depreciation schedule as well. One thing is really important, and I think I mentioned this a little bit early into the podcast, is that when we've got property investors or should I say owner occupiers like myself back then, if you buy these properties in today and you decide to, okay, I'm going to live in it for a year, then I'm going to rent it out. The ATO has come up with that new legislation back in 2017, May, the budget, when they had this issue where they thought, okay, well, there's so much depreciation being claimed. And I really think that there were so many property investors in the market and they were just trying to diffuse that with the Royal Commission and all that. But I won't get into that. But really, that drove home the point that they wanted us to reduce the amount of depreciation people could claim. And what they did was when I mentioned earlier about plant and equipment and building, what they did was if you buy an existing property that's secondhand, that means it's you bought it off someone else. That asset, the building and the plant and equipment assets within that building can no longer be depreciable.
Okay. Yeah.
So they won't let you buy a secondhand property like I did and claim depreciation like I used to. They've abolished that. So now as a property investor, an individual taxpayer, you can no longer claim depreciation on secondhand plant and equipment. But not to say we can't claim depreciation. We can still claim depreciation on what is called capital works or building depreciation, which is at 2.5%. And this only applies to SMSF and individual taxpayers. So if you buy it in your sort of your self-managed super fund, or you buy it in your individual name, you cannot claim depreciation on second-hand plant and equipment. Only can claim building depreciation on the structure itself.
I'm starting to get this because I was going to say, what happens if you, moved into a place and the oven was over 13 years old? Like, it doesn't make sense that you could claim that because it's already been claimed essentially. But
that was happening. Yeah, correct. And that was the idea of the idea of the ATO recognizing that people were overclaiming on overvaluing assets over and over again. But back then the logic was that, okay, I bought a secondhand property, but there's still some residual value in that oven. But now if the new quantity surveyor comes in and says, okay, well, that oven's worth $1,200 and originally it was only paying $800, well, there's a problem.
Yep.
So there was no actual merit, and now what they're requiring is an actual receipt. So you can claim plant and equipment on a secondhand property, but it has to be a brand new asset that's bought from Good Guys or Harvey Norman, installed with a tax invoice.
Yeah, for sure. Yep, paper trail.
Well, that's interesting then. So say, if we're the difference between then doing your own work or cash jobs. Sometimes we'll try and obviously save some money up the front by doing it ourselves, or we might save money at the front with a tradesperson by paying a cash job. Is then so?
Are you saying that you defraud the government, John?
Never, never. That's in quotes, right? Hypothetically, this happens sometimes.
You've got a mate, a mate.
Exactly. You know a guy or gal. So if then imagine you did all the work. Even your investment property, you were very handy, so you could do all the building work yourself. And then, but you didn't carry any receipts of the work or the cost of any of that material. Can the quantity surveyor still work with that, or are really going to? If that's, I suppose, a thought. Then, if you are going to do the work, do you want to ensure that it's, ensure you've got receipts, or you do it yourself where you don't? What's going to be the better option in terms of your long-term tax benefit on a quantity surveyor?
Good question, John. And we do. I'll be honest with you. We get a lot of clients that have this same issue where obviously getting trades in and cash prices, whatever it might be, it does save them costs. And our job is to then ask the client, now, what what do you think you've expensed on the property? And obviously, typically they will always overquote what they've spent. But my job is to bring some fact into the actual build itself. A lot of the time, it's typically a granny flat, or it might be a reno. And what I do is, as a quantity surveyor, similar to what we do with existing plant equipment, and the rule still is protected, by the way, for the guys that are buying property prior to 2017 and they're organising tax depreciation schedules now, we can still organise a report and claim the second-hand plant and equipment by valuing that asset without any receipts. That was our job. And that same principle applies to somebody who's built a brand new granny flat and they said, I've never claimed depreciation. I don't know what it's worth. And in terms of, tracking receipts and logging the costs, a quantity surveyor can go out there and measure out the building, work out whether it's brick veneer, terracotta roof tiles, size of the slab, and roof openings, window openings. All these costs will then amalgamate to a depreciation schedule that will be compliant with the tax office as long as we can cite it, witness it, and work out to the T every sort of nut and bolt on that property that's put together. So definitely it's something we can do. Same thing if you buy a second-hand property. For us to work out the construction costs of a property that's already been sitting there for 10 years, we have to go out there and physically measure every square meter of the building, wall, bathrooms, the whole shebang. Oops, sorry.
She's right, mate.
That's all right. Just getting excited.
That's it. I hope that makes sense, though, in terms of being able to value. Of course, it has to be at market value. It has to be fair and reasonable. And it's always at the discretion of the ATO. If the ATO feels that the quantity surveyor's value is overquoted or underquoted, they do have the right to obviously discuss with the client on how they sort of come across these values.
See, that's really interesting because I've got a friend of mine and they have effectively tried to not engage any person by paying any person of any profession, any professional fees. So it's the case that they're doing it all themselves. And one of the things, she talked about was she'd organised her own depreciation schedule. And when I sort of got an idea, I said, look, I don't need to hear anymore. Just so you know, you're doing it wrong, but here's some people you need to speak with, but that's totally up to you. But see, and I come back to the idea where you said you're a construction economist, where so in that case, what she was doing was most likely overvaluing all her assets and then, making claims on it anyway. But if ever that was to be analysed, they'd be like, where did you come up with these numbers? Where's your profession to be able to back this up? So we want to see some proof that these values that you came up with are, true and correct and fair. So then the thing is, I suppose, why it's so important to engage a quantity surveyor like yourself, go back to construction economist, is that from a tax officer's perspective, you've got the qualifications, the skills and the knowledge to say, okay, this terracotta tile that we've, though we don't have the specific receipt to pay for it, we can back it up by saying we've measured it. Here's some common elements of what they might cost at the time. So that's why we've come up with this fair value. It's not a means that you've been able to do an exact like for like, but because of your expertise, you can still create a fair value. Therefore, the tax office deems that's fair and they will trust that advice. Is that a good summation of that?
That's perfect, and that's exactly right. And the whole idea as a property investor or as a taxpayer is we don't want to take the risk on of doing things we're not sure about, especially same thing as when we go do a tax return, we go see an accountant at a registered tax agent because we're not sure what is depreciable, what is something we can expense. When you can expense it, you can claim a complete write-off on it. And so, when you go through a depreciation schedule, same thing. If I came across something and someone said to me, well, this wall fell apart and it was molding, so I had to sort of replace the wall. Saying, can you depreciate? I say, well, you don't have to depreciate that wall because the wall was rotting. You have every right to replace the wall and claim 100% deduction of, say, you spend $1,000 on plasterboard, claim the thing right off. Otherwise, $1,000 on plasterboard, you'd be claiming 2.5%, which is $25 per year for a very, very long time. And you don't want to be doing that. So that is the benefit. And as quantity surveyors, we are registered tax agents, similar to an accountant. However, we have conditions with our registration with the tax board, and that is we can only advise on depreciation. Very important thing. And the tax ruling, if anyone wants a reference, is TR 97/25, which the ATO says you are entitled to claim depreciation on your residential or commercial rental property as long as it is done by suitably qualified persons, which is listed below, and one of those is a quantity surveyor.
So that's an interesting distinction. So where obviously we've got two, you could say you've got two accountants in your team at this point. You've got your personal tax accountant for your incomes and all that kind of stuff, and then your quantity surveyor. So if I'm looking for, I'm sitting there, I'm stuck, I'm going, oh, okay, which person of my team do I ask about the depreciation on my property? So I would speak with you first. You'd give the correct written advice so that we would then provide that to our accountant that would then apply those deductions to our income statement. Is that how the team would work?
Yeah, so typically, everybody, the tricky thing about where the space I'm in is being a quantity surveyor, no one has any idea what a quantity surveyor is.
That's it.
So typically our work is mostly B2B in that we are referred the work from an accountant. So typically a property investor first time says, okay, I better go see an accountant because of, it's getting a little bit tricky. I don't know what I can claim, what I can't claim. So they go see an accountant. The first question the accountant always asks would be, well, one that is savvy would ask you, do you have a tax depreciation schedule because you've got a rental property? Then they say, no, what the hell is that? Then where they get referred to a quantity surveyor where they're pretty much their tax return is literally everything is compiled, put together, drafted, ready for submission. And all it's waiting for is two items, which is your plant and equipment and your building depreciation. Once we get those assets assessed by a quantity surveyor, that quantity surveyor will send that file across to the accountant for lodgement with that tax return to finalise and get the final amounts, because typically there's always a balance owing. So my job is to reduce that and get into a position of refund rather than payable.
Absolutely.
Hell yeah.
Well, so then we've obviously organised like a full schedule, but like you said, where there's the wall rotting, so we've replaced that. Is that then, if any then building work that you do within your investment property, you have to refer that back for advice to the quantity surveyor? Is that the person you need to be asking that advice from?
That's correct. Typically, I mean, with anything, when it comes to being able to claim something, as long as we have written evidence, it's cases where there isn't written evidence that the quantity surveyor can be very helpful. But if, for example, you've got your depreciation schedule, you go and buy an oven in 3 years' time because it's it needs a bit of an upgrade, you can give that $2,000 oven receipt to the accountant, and he can create his own depreciation schedule. It's when things get a little bit more tricky, when you've got a whole investment property and you've got a building contract that says $250,000 for this brand new house. But then within these building contracts, they don't tell you what the oven cost is, the range hood, or the aircon. So that's where and if you would claim $250,000 over 40 years, you're doing yourself an injustice. You'd rather say, okay, $250,000. $175,000 is your building, and the $75,000 is all your plant and equipment. And if we can get $75,000 reduced down to, say, we can depreciate that aggressively instead of claiming, let me just work that out, divided by 40 years, you're getting $6,250 on $250,000 in total construction costs. So $6,000 deduction. But typically on a $250K property, based on my experience, you'd be claiming probably around the $12,000 to $15,000 mark in the first year alone. So you've doubled your deduction because all you've done is go to a quantity surveyor to value plant and equipment separately from the building, which is where the value is.
And so that's the idea that, if the cost of a report for $500-600, like you said, is negligible, because instantly you've pretty much got all that return back within your first year or two alone. So it's like, why wouldn't you even? It's like you'd be silly not to engage a quantity surveyor on that idea.
So my other question to that is, like, when I go to the tax man, like I used to do it all myself when I was just a lowly student, and you put it all through, and then someone's like, oh, if you go to the tax man, you can claim it the following year and you get that as a deduction. I assume that would be the same with your services?
That's right. So if you organise our services before 30 June, of course, you can claim it straight away on the tick over 30 June. But if you organise the report when your tax return is due, typically July, August, September, then yes, the fee for the report of $600 will be claimable in the following year as a tax deduction, as an immediate deduction.
Fantastic.
Awesome. I told you I was getting it.
Absolutely. So
Aaron for the win.
So how do we engage your services? What's the process?
I guess typically the process is a lot of people with brand new properties, that would be a no-brainer. You've got to get a depreciation schedule. When it comes to existing properties, there's some guidelines. The ATO won't let you claim depreciation on secondhand properties, as you know, on the plant and equipment. And the building itself, there is a criteria, and it has to be built, I believe, after the 17th of September 1987. So if you want to qualify for depreciation, that's the criteria. And our job then is to grab the details. So I need, once the client calls through or the property investor calls through, we'll grab the rental property address, work through it with RP data or CoreLogic, work out the building details, and we'll say, okay, well, based on that information and the photos provided, my estimation of the build age is around 1995. Based on that, we can then start saying, okay, this is the depreciation that you can get. We might value it at, say, $2,500 as a guaranteed deduction based on our experience and based on the information provided by CoreLogic. We can then go ahead and organise a report if the client agrees to that guarantee. We go to the site, we might be able to yield a bit more, 3,000 or 4,000, depending on what we find, but at least we have a good basis to work on based on just a data bank of information that we have and based on our previous experience with other clients. This is what you can claim on a 1995 built house based in Melbourne. So that's what we'll do.
That's good because, I mean, anyone obviously worth your salt in your game. So if they were to call you, you're quickly going to be able to give advice to say, look, we are going to be able to make this work or not. So you're not going to be pushing your barrier to say, look, you need to get one when it legitimately is not going to help someone.
100%. We've got over, I think, 1,000 5-star reviews on Google. And I don't think we would have achieved that unless we had been fortunate enough to be in this business of giving away money, tax deductions and tax refunds.
Yeah, absolutely. Well, that's great. Well, I mean, lastly, we've mentioned that if you are an investor, you need to speak with a quantity surveyor, quite simply.
Essentially.
Nothing more to say on that. It sounds like we've ticked it all off.
That's fantastic.
Thanks so much for your time today, man. That was actually a really interesting listen. I was dreading waking up. I was just like, I don't know anything about tax. How can I be involved in this conversation? But you're very charismatic and you've given us a real insight into all that. So thank you very much.
I'm glad, and thank you for having us. Appreciate that, guys.
Not a problem at all. Just for anyone out there listening to get in contact with you guys, what's the best way to reach out to DuoTax?
The easiest way is to just give us a call. So it's 02 899 1133, or you can just email me directly. It's Tuan, that's TUAN, at DuoTax.com.au.
Awesome, man. Thank you so much. And thanks for joining us on the Property Pod.
Thanks so much, Tuan. That was
Thanks
great.
a lot. Appreciate it.
Well, John, you've done it again. You've found yourself a guest who initially I thought we were going to have a real slog, but that was really good.
Yeah, it's incredible though, eh? Like, I mean, in the end, all this stuff's a dense subject, but the second you can get a good base understanding of it and then you've got someone good in your corner, it actually becomes an interesting topic to talk about because in the end, fundamentally, there's people about putting more money in your back pocket. So why wouldn't you want that?
I think after me listening to it maybe 1, 2, 3, 10 more times, I might have a grasp on it, but you were getting it out.
Yeah, well, it's funny because as I was coming in, I was just like, man, I'm so scared. I don't know what I'm going to ask this guy. Like, how can I drive a conversation I've got zero info on? And he was so charismatic and kind of had it all down that he was, it was a good listen.
In hindsight, there's only one part of the conversation I need to remember. That's a number at the end. So when someone asks me the question, I just give them the phone number over and all it.
Let him take over. Yeah, exactly.
Yeah,
well,
for sure.
I guess that's the point, if you want to get right into it, you can, but if you don't, you pay the money, you give it to your accountant, job done, So that's the whole point of having good people around you.
It's good though. It's one of those things where, as he said, he knew nothing about it. It's kind of fallen into his lap and now he's kind of run with it and taken it off. So like it's something that, again, I knew nothing about. If someone was to ask me later, do you know anything about tax depreciation? I'd be like, I know very little. But I did have this one guy tell me about it once and, I kind of understood it afterwards.
Absolutely. Well, I mean, it's been through the case. We had Taylor talking about insurance and her first experience, like getting the organising insurance at the beginning of the contract. We had, the title insurance element. Like there's another part that, when would you even ask that question? So it's even always... it's taken all these years to even realise that, been in the game for so long, you're still finding out new people and new expertise that you need to rely on.
Now, John, I'm a deer in headlights when it comes to freaking talking about insurance and stuff. So can we talk to someone else next time so I can get in on the conversation?
We'll bring Taylor back there.
It just like glosses over me. I'm just like, this is so confusing.
Well, I think you guys have got a guest coming in soon. I think I'm away the week our next guest is in, but we will endeavour to continue recording. And look, if you guys need a hand, shout out and I might be able to sort out the hookup.
All right. Beautiful.
But yes, thank you for Tuan at DuoTax, and we'll be back next week with more Property Pod.
Cheers, gentlemen.
Thanks a lot.
Awesome. You have been listening to The Property Pod, produced and edited by 414 Media House in conjunction with 414 Real Estate and McGregor First National Propriety Limited.
This podcast is general information only, and the thoughts and views expressed is the opinion of our panel, and listeners should always seek and use their own investigation into any topic we discuss to ensure they fully understand their own situation.
It does not constitute and should not be relied on as purchasing, selling, financial or investment advice or recommendations, express or implied, and it should not be used as an invitation to take up any agent or investment services. No investment decision or activity should be undertaken on the basis of this information.